Hi, investors. It's Nick.
Hi from Martin.
And today we're just going to do a general recap of what we're seeing in the market, what we're adjusting within the business, and I want to talk a little bit about some of the research I've been doing. Um, I think before we get into the kind of low level stuff, I'll just say I've been doing a lot of work in the background on answering a very big question, which is it a good idea to actually invest in property? The reason I'm asking that question is for me more than you, I'm afraid to say, but you get the benefit if you're interested in the research I've been doing. The reason being that my family are coming into some money soon, and we've got to make a decision. Do we sit on cash and wait for the property crash to come through, then come out and buy a load of property, or do we invest sooner than later and do we do that? And overall, my view is that we're in for a period of prolonged high inflation, and that if we wait for the crash, which is likely to be 2 years away, and we wait for the market to bottom out, which is another 18 months, that's 3.5 years, and inflation is probably going to move along at, say, 8 to 10% a year. So worst case, we're likely to lose 25% of our cash wealth if we just sit on cash. Best case, or likely case, worst case, I would say 35% if things go a bit crazy in this country. And it might do, because we've got so many big kind of high level pressures around fuel costs. We've got an immigration problem, as in we don't have enough immigrants. So wages are being pushed up. It's just lots of issues. And what I've seen from the capital growth research I've done is that if you buy in the right kind of area with good demographics, good local economy, all the basics, then the probability is that the market will crash from peak of cycle, i.e. 2 years from now, by probably 10%. So it ranges from like minimum, it's positive actually. So I've seen a few areas which have gone up in value during the last crash. But on the whole, decent areas that we like, say between 8 and 12% negative growth. So what that means is that if you buy now, then you buy early enough, and then the market goes up and you get a bit of a decline, but you hold the value. That's the nominal gain. But in the meantime, something very interesting is going on, which is that rents are likely to keep creeping up in line with inflation. Interest rates remain low and are likely to for a very long time. I know this because if you look at the 10-year fixed rates, they're 3%. So if the money people thought the rates were going up, they would mark up their long-term interest rates that they're charging, the bank interest rates. But they're not, because like me, they think it's going to stay low for a long time. And there's a whole bunch of reasons which I've talked about in various videos. So what I think, just overall, my feeling is the game has shifted from chasing the big capital growth, certainly in Manchester, to preserving wealth and looking for stable long-term capital gain. And so what I think is that there are places like Doncaster, which we're talking about a lot now, and the housing stock is good. The market is warm, but not red hot, and we're able to compete, especially for those clients who have mortgages, because at the moment in Manchester, what we're seeing is that either the only viable deals we're seeing, and bear in mind we do a lot of viewings, a lot of assessments, a lot of stuff, clients are getting out competed if they've got a mortgage. So either the property has to have a big compromise, so they pay a whole load of money for it, or they're lucky. I mean, luck is a big part of this, or it needs a huge renovation, or there's some problem. But generally speaking, as you know, we throw out most problem properties. So there are some problems which are manageable, like we could handle the renovation properly, or it's a tenanted property, or whatever. But what I'm seeing on the ground, talking to agents every day as I do, is that Manchester has gone into kind of hyper mode. Now, there's two parts to this. So Martin will talk about his experience with this, but just on a kind of granular level, when I'm negotiating with these agents and stuff, um, what I'm finding is that the outlier areas, Radcliffe, Middleton, these kind of places, they're now beginning to get quite hot. And we're only able to compete on properties we really don't think you should buy. So it's like buy at your own risk, but we tell you. And we had a scenario the other day. Somebody bought a house in somewhere on the east side of Manchester, up in the hills, and
Yeah,
it was a what was the area?
Ramsbottom.
Was it Rams?
Ram,
Yeah. And the
but
problem
Ram.
was the property itself was fundamental. It looked pretty. It had a clean interior, recently renovated. But guess what? The property was one of these ones on a slopey street. And instead of the roof being like a stepped roof like that, whoever built it back in the day decided to do slopey roof. So in other words, anyway, the point was the roof was rotting. The whole thing was and so this is a classic case of someone falling for a compromised property and getting absolutely screwed by it because it's so high risk and so, it's like the classic case where it looked good, but actually it was fundamentally a mess and it needed probably £25,000 in it to redo the roof, which was awkward to do because the way the roof was sloped at an angle. So roofs are generally like horizontal and they have slopey bits either side. This, if you imagine, was at a slope and then the slopey bits were like that. So just awkward to work on. Why am I dwelling on this? Because this is a classic case of compromised property and we don't recommend properties with these kind of compromises. So what we're seeing is fewer and fewer properties where we can actually compete. So the constraint is that if a client is offering with finance and they offer very high in a compromised property, they get caught out in the end anyway because the mortgage surveyor will say, nah, it's not worth it because you've overpaid, because they'll look at it and do their thing. Or the survey will say, you know what, you're going to have to spend a huge amount of money on this thing. So I just don't think Manchester is viable at the moment on the whole. I think there are deals and there are interesting spots, which Martin will talk about. But as a whole, just too many misses, too many offers not accepted, and too many sales going to cash buyers. So what I think is going on is you don't need much, right? You don't need much of movement you don't need much extra pressure, let's say, to create a huge change in market characteristics. So only about 3% of properties are sold in an area every year. And what I think's happening is that we're getting a lot more desperate cash buyers who don't really care about the value. They just want to sink the money in and move money, essentially. So that's fine. If that's your agenda and you're desperate and you want to get rid of money because you know inflation is going to eat you up. So again, I go back to my first point about inflation. If I sit on cash for 4 years, 3 years or something, I lose 20, 30% of my wealth. What's my choice? What do I do? And the answer from a lot of these people is they're either trying to get money out of somewhere like Hong Kong, or they're sitting on cash and they just got to move the money and inflation is killing them. So of course they're getting stupid and making stupid offers. So the way out for us is to start recommending more properties in places like Doncaster. We've suggested a couple of properties in places like Oldham, but I think we've got to not offer, places like Oldham are tantalizing because you go, well, it's Oldham, it's cheap. But it's fragile, and my view, and I don't know what Martin thinks, it's over to Martin in a minute. But I just think we're in for the most horrific time economically over the next 10 years, and it's a consequence of Brexit, which would have been bad anyway. But then you have effects of COVID. You've got the effectively the reshoring, where the world is separating from China because US and China are going to go at it together and fight it out. We've got the Russian situation with high fuel costs and just all of that trouble. And we've got a government that's very anti-immigration, so we're going to have real labor shortages and so on. And effectively, we have to reinvent this economy, and it's going to be hard, and it'll be like the 1940s. And it'll be another 8-10 years before this country comes through and reinvents, and it will, because people are resourceful. But for these reasons, I think it's an incredibly bad idea to fall for the old thing about buy in Manchester because it's doing great. Buy that compromised property near Oldham, where only economically fragile people will live. And yeah, it'll rent out nicely now because everyone's desperate. But wait for the crash. Wait for the... Oh, and the other issue that we've got is what's known as the Great Resignation. And this is where, after COVID, lots of people just said, no, I'm not going back to work. And the market is the employment market is drying up. But what will happen is that you have a pendulum, and then we go into real recession. Businesses will close down because prolonged issues, and then we fall into a nasty space. And so the properties that are going to do well are those ones which nice middle class people who have reliable jobs will continue to have their jobs. So it's an old theme, we keep saying it, but it's very easy to fall prey and go, you know what, I'll pay whatever it takes for that nasty little house that's in relatively poor condition, that will never attract a good tenant, really. But I got to do it because it's Manchester. Well, I just say, well, don't. Like, Manchester is still my favorite, but I think there are areas where it's now overbought, and it would be a bad idea to buy. So Salford, Swinton, Stockport, the usual. But anyway, that's my view. That's my general thesis, that in summary, you got to get on with it. If you got cash burning a hole in your pocket, just get on with it. Invest. Use property this is me for my advice, right? But I'm not financially authorized, etc. You make your own decisions. But what I want to do is invest in property as a hedge against inflation and wealth erosion. I want to hang on to my money, and I'm going to use property for it, and we'll just see how life plays out thereafter. I will be doing a proper video on all of this with all the numbers and the projections and the rationale and all of that separate to this. So a bit of a monologue from me, but that's kind of how I'm feeling. I'm not a happy bunny generally. I think our hit rate for Manchester is just not good enough. And I think if you're buying with a mortgage and you're not prepared to offer stupid money for property, then don't bother. I think go somewhere else. That's my view. Martin, what's your opinion?
My opinion, yes, avoid central Oldham, avoid central Bolton, and also the hot area as Salford, Swinton, Stockport. Maybe there was good purchasing few months ago, but now what we notice is even getting hotter. They don't allow in the past 30 viewings. Now they're doing 20 viewings. And from those 20 viewings, they will have 7 or 10 offers. And if the asking price is 170, they will go up to 200. So if you really like to buy, maybe not the best and the smartest option right now, yes, you can. Yeah, but you need to really beat hard, pay a lot.
Or risk. The big problem is that the houses. I saw one today in somewhere, Stockport or someplace.
Stockport.
Yeah, and we booked a viewing in for it, but I really don't like it. I think it's a fairly miserable property, and what I'm seeing is relatively low quality properties going for quite high money that isn't really that affordable in Manchester. Rents are pushing up, so great, but I don't expect rents to push up forever. because rents are related to economic productivity and wealth creation and so on. And this is just not the kind of house that a young, profession. I mean, maybe they will, but I'm just not feeling it. But anyway, back to you, Martin.
But for this property, for example, in what we talked about, Salford, it was Salford, I think, or Stockport.
Yeah.
No, yeah. This was like an old terrace house built like after after First World War, like 20s, 30s, something like this. It was renovated in the past, like maybe 40 years ago.
Yeah, it's okay, but we know that this is going to be hotly competed for, and the client is going to have to spend over 10% of the asking. So I think it's 180 or something, isn't it? 190?
190. But anyway, this location, it will be a lot of competition just because because it's central, and the rent here is going really and it will rent super fast because of the location. And people love this kind of location for renting. And also spoke with Leila, and so yes, so that's why this location. That's why they're bidding high, because also the rent is going high there, and it's increasing every day. Almost it's increasing the rent.
Yeah.
And a lot of people who coming from abroad want to, because they don't know a lot of areas in Manchester. They don't want to go far away. They want a house. They don't have flat. They don't want a flat to rent it out. So basically, they fight for this kind of deal to rent, because right now the rental market is not that. You don't have a free house to rent. So basically, all the property will rent super fast. So also the rental market is super hot, especially in central Manchester.
Well, it turns out, just as an aside, so in this country, I think it's called Section 21, the thing where if you were a higher rate taxpayer, then you couldn't offset basically it made, the legislation made it really difficult for higher rate taxpayers to personally own buy-to-let property. And there was a huge sell-off. And it turns out, according to the National Association of Landlords, I think it is, that housing stock is halved. The rental housing availability is halved because of Section 21. So people are just desperate to rent. But the catch with that is, until they're not desperate, and then the market just plummets. So it's that old thing where markets work in cycles, and when things get too hot, you got to be careful. But yeah, great that there's plenty of rent. And the good thing is that with mortgages, it's always nominal. In other words, the mortgage is the mortgage, and that mortgage doesn't go up in line with inflation. It goes up in line with interest rates, which is generally predicted to be low for a long time. And rents generally go up in line with inflation because rents, people pay a proportion of their income to rent. So it's okay. The equation is kind of okay, but the higher you pay, the more you have to wait for this to be a useful asset, or because if you overpay and the market says no, you overpaid, you've got to wait some years for the price of the property to creep up. But the property doesn't creep up linearly. It goes up, then down, then it goes flat, then it starts to creep up 10 years time. So anyway, what were you saying? Sorry, Martin.
Also, we had one situation in Doncaster as well. We even bid high, like 20K more than the asking price. The owner just decided to not sell to investor. Even if it was for personal use, the owner didn't decide to sell to them just because we didn't really view the property. I mean, the owner who was sending offers. So basically, sometimes it's just a lack.
Yeah. So with that kind of situation,
what I notice is not only this kind of situation, a lot of situation is even you bid high, the owner will not want to sell to you. So it's just a lack. So what I notice, half of the deals are going because of the lack. Half of the deals, what we don't accept, is going just because of the highest offers. So, and maybe let's say from 10 viewings, we will send offer to 6 or 7. Let's say 7. 3 will not send because it will be too late, or it will be so much competition and it's not worth.
Or the property won't be worth offering on because we
Yeah.
found an issue that we just say,
Yeah.
no, don't do it.
So 3 will be like this. On 6 or 7 we will offer. 3 will be like overbid. 3 will be like just don't want to sell to you, and we never know that before if we don't do the viewing. And after the 1 will be accepted. So we have like a low rate acceptance. We're working on that to improve, but sometimes it's just a lack. So, and you never know. And generally we're trying to, if I know that the property will be hot, I will not send in the group, or I will write, if you really like this kind of property, be prepared to, even if the property go in a bad condition, if you really like to take it, like to not spend your time and our time and your money as well, just to be prepared to bid high. So that's like I will start mention this in the comments. So be prepared to bid high if you want this, if you really did want this property. I will spend like a little bit more time to analyze the property and how and the offers, and to see the location, to give my like a comment about it. So from now on I will start doing that. So basically you will, if you really like this, and I will keep sending those deals, but not a lot. I will reduce them if I know that some property will go crazy and it's not worth in this situation, then I will not send. So for example, if I was sending like 10 properties in Manchester and like 5 was in the hot areas, now you will see like only 1 or 2, just the ones what we think that I would think that we have a little chance to take it. And also what we notice is we was giving chance to Purplebricks so many times, but now we will not.
Yeah, Purplebricks are just so irritating. We've done about 20 viewings with them and we've had no sale. So
maybe 50.
Just so annoying. So what's just with Purplebricks, just to say, you may find properties, you go, oh, that's cheap. Well, fine. But what happens is Purplebricks, Martin alluded to this earlier, by the way, Purplebricks, the one about sentiment, about they don't want to offer it to you. Purplebricks are a direct-to-vendor organization. So a vendor pays money, like £1,000, whatever, and then they market the property. So fine. But what happens is the viewings are generally undertaken by the seller, the vendor, and not the estate agent. So what then happens is that the vendor gets to meet the prospective buyers and they pick who they like. So we had this situation today in Doncaster, lovely property. Client offered 20,000 above the ask and was prepared to go 25,000. It was 190,000, willing to go up to 210 and 215 even. And this is unusual for Doncaster because it's not such a hot market. Manchester is typical. But anyway, the vendor said no. So why was that? Well, it turns out the vendor had a conversation, met one of the people doing the viewing because they were doing the viewings and liked them and said no. So, it's just one of these things. Sentiment is a thing, but Purplebricks is especially bad for this because vendors don't understand what's going on. They're not professionals. They chop and they change. We've got a whole load of logistics that go on in the background to get viewings done on time consistently. So yeah, I just don't want to do any Purplebricks. Well, neither of us do because it's just an utter waste of time. We're better off concentrating on where we're more likely to succeed. The other thing I want to say is on the theme of just improving our hit rate and so on, is that what we find with clients is we're always asking, what would you like? What would you like to buy? Have you got any requirements, etc.? And they usually go, yeah, 3-bed semi-detached. I like them, or whatever. I like ones in Moston, or whatever the thing is. But what we find is that what clients want and what they actually really want are not necessarily the same things. So the reason we do this system where we put out a flow of properties and you put up your hand and go, I'm interested in that one, as opposed to custom searches for you, is because we would never get anywhere if we did searches for you. Because you as a client, because on the whole, people don't know what they really want until they're confronted with choices and they go, okay. And if you actually ask yourself as a buyer, what do you really want? Can you really define what you want? What are the characteristics of that property that you really like above all others? I can do it for me, but can you do it? And so what's happened is that people, they say they want Swinton, Stockport, Salford, they want all the hot areas. And then when it comes to it, we just fail time after time after time. And we're not going to do that anymore. So we're going to find properties that are viable, where we are confident you have a serious chance of buying. Amongst our clients, there's a general profile. It's like mortgage buy with Gatehouse usually. If any estate agent knows what Gatehouse is like, they'll say no to you because Gatehouse is a pain. They're reliable. They'll get the mortgage in the end, but it takes a very long time to get there. And lots of agents I've talked to get burned with Gatehouse, and I have to apologize and do some spiel to say, well, it's okay. These are great clients. They got the money and blah, blah. But on the whole, most of our clients have net cash between 100,000 and 500,000 pounds. And generally the people with the higher amounts of money are easier to work with, because if we make an offer, there's an implicit understanding that if the mortgage falls through, they'll buy with cash. So we have a higher hit rate with them. But people on lower cash, nah. We're just not getting anywhere with Manchester, with these weaker buyers, unfortunately. And the only option is to find other areas. But Manchester is an incredibly strong place. Long-term outlook is awesome. But if you want to get your money out of cash, avoid your wealth being eroded by inflation, you better get it into something that delivers 7 to 10% ROI per year to cover off the effects of inflation. And property is it. And right now we like Doncaster a whole lot. Sheffield is okay. Parts of Manchester, so those areas outside of, around the ring motorway of Manchester, Middleton, Radcliffe, those kind of places are still okay. But that's just my general kind of view, that it's shifting, and some clients will not want to work with us because they'll be going, I want to buy in Swinton, whatever. Great, good luck to you. We won't be able to help you, because unless you buy compromised property that's got a lot of risk, your choice, then it's likely that you're not going to get very far, because the market is relatively efficient and people are losing their minds in these areas. So, and as ever, I'm doubling down on where the growth is, where is a good, safe place to buy, because repeating myself, things have changed. We're now entering into the preserve your wealth phase, as opposed to get the capital gain, see if you can win. Now it's about capital gain. Fundamentally, it's about capital gain, because if you don't have that, you're absolutely screwed. But it's about safe capital gain. That's the trick now, I think. Anyway, what are your final thoughts, Martin?
Yes, as you said, try to avoid this hot area if you don't prepare and if you don't have enough cash if the mortgage collapses due to.
Oops. Connection dropped. Come back, Martin. Where are you?
But that doesn't.
You're back.
That's not.
You're back. Could you just repeat?
Correct.
Your connection dropped. Could you repeat basically the last paragraph?
Yes. If you like to buy in Salford or Swinton or Stockport, and you really like to buy there, you must have at least cash to cover the purchasing price, because if your mortgage collapse, you just need to have the cash to convert this to a cash buy and after refinance. Or if you have enough cash, if you really like this area, you will have chance if you only go in cash offer. In mortgage with Gatehouse, the hit rate will be we need to see 20 properties, send 17 offers, and maybe then you will have a chance to buy one, maybe. Because
Yeah,
right
but the
now,
catch is that if you make us do about 25 hours of work and you're not getting a hit, unfortunately, we will say it's been fun, but let's try something else, basically.
yeah, and it will be waste of your time, and you will fall in love with some property, and on the end you will not have it just because of the competition. But if you have
Yeah,
100K in cash and you want to buy a property of 200K with mortgage in hot area, you don't have any chance. Basically,
yeah,
you don't, because why they to risk a chance the mortgage to collapse, to fail, and then the deal will collapse and they need to advertise it again. So the agents will not take that risk. So if you really
exactly.
want to
And
compete, if you really want to compete in hot area, you need to have cash. So with cash, yes, you will have more chance to take it. And
yeah,
then we can go with the hottest area. But if you don't have enough cash to buy it in cash, if the mortgage application collapse, just ghost. My suggestion is like stay away from hot area, even from Manchester, maybe.
yeah. I agree. And the other thing is that the what I think is going on is that people know how hot things are getting and they're getting nervous. And so, like investors know, and if they're selling, they basically the bottom line is that your proceedability is incredibly important. As the market goes higher, everything gets more fragile. And therefore, sellers want to make very sure you're proceedable. And if they're confronted with a choice of like 6 or 8 offers, and one of them is cash, it's slightly lower, but it's cash, and it's from a good buyer, well, they're going to take it, and you don't have a chance on a mortgage. So, but if you do buy for cash, fine, just refinance as soon as you can, or at least that's what I see from all my analysis. It's all about like preserving wealth is essentially about getting mortgaged and keeping the interest rates low, getting fixed interest rate deals for a long time, and let inflation erode the value of mortgages and also rise the rate of the rental income. All right then. Well, I think that's kind of it from me. Anything final from you?
Yeah, just stay away from risks like close to gas station, close to highway. Stay away with constructional issues, property. Stay away from floating issue or coal mining issues. Buy a safety location, safety property who doesn't have any risk, and with yield, even 5% of yield is will be better investment than some property with 7% of yield and have some issues, risk, compromises. So yeah, if you don't have enough cash, just like try to find some not that hot area, like maybe even like Sheffield, Doncaster, Crewe, and Warrington, Wigan, I don't know, even Leeds, I don't know, Nottingham. Maybe there is a lot of small towns where you can invest and you will have not that much competition and you will have more chance to purchase a property, and it will be safe investing because of it will rent always because it's a small town and there is not a lot of private rent.
Yeah. Well, we
So
found a couple of properties near Doncaster, like this little towns, like there's Mexborough and there's a couple of other little urban conurbations, which are part of the Doncaster conurbation. But as a whole, what we're doing is steering. We're going to recommend properties where we think you've got a decent chance, and some of you may say, no, we don't want any of that. Goodbye. Hopefully, some of you will see it makes sense, and we go from there. But as you know, as ever, we're trying to do to help is to tell you our truth of the properties, i.e., we do our best to assess things. We do our best to tell you that tell you it as we see it, as objectively as we can, and you either buy it or you buy into you either follow what we think or you don't. But hopefully you think clearly on your own account, as it were. And as I say, we just try to offer you the truth of every property, because that's how we can help you. But anyway, there it is. All right, very good. Thank you very much.
Thank you.